Welcome to Financial Insider Weekly. I'm your host, Michael Gray. My guest today is Raymond Sheffield. I'm just going to call him Ray. And Ray is an attorney specializing in trusts and estates. He has his own company, Sheffield Law Office in San Jose, California. He's been a lawyer for 13 years. He received a JD degree from Santa Clara University and an LLM degree in estate planning from the University of Miami in Florida. And Ray tells me he loves the role of counseling clients for their estate planning. In addition to his law practice, Ray is an adjunct professor in the Golden Gate University LLM tax program. And Ray and his wife live with their two adopted daughters, ages 6 and 8, who are from Russia, in Almaden Valley in San Jose, California. Today, Ray and I are going to be talking about estate planning for retirement accounts. And as we get started, I want to caution our viewers, we're discussing issues in a very complex area. It's actually a huge area. There's no way we could cover it in this time. We're just going to hit some highlights. It's a starting point for a bigger discussion with your own attorney and tax advisor. Also, we're mostly addressing things from a federal and California standpoint. So for example, in California, we have our own flavor of community property. Other states have community property that works a little differently than how we handle it here. And so, and some states don't have community property at all. They have separate property. Anyway, viewers in other states should definitely seek advice about their local laws. So, Ray, thanks for joining me today.
Thanks for having me, Mike.
So just to give you folks a reference, today is November 19th, 2013, so God knows what Congress is going to do to us. We have expiring tax laws, other things that are going on, but we can just talk, of course, based on the things that we understand right now. Ray, why are retirement accounts a special class of assets for estate planning?
Well, Congress decided that people weren't saving enough money for retirement. So they set up retirement accounts in a tax-advantaged manner to allow people to contribute to them and get an income tax deduction or something on that and save that money so it can accumulate and grow tax-free and preserve some savings for when they stop working and need to retire. And they're really designed for retirement, not for passing money on to your kids or something like that. Mm-hmm. And so they're also not really dealt with in most wills or trusts because you name a beneficiary as your as who's going to get whatever's in this account when you pass away. Mm-hmm. And so it's not always part of the normal estate planning process that people think about or go through. So that makes them special as well.
Yeah. So I call them sort of invisible assets. I mean, if you ask people to make a balance sheet for themselves, and first of all, let's say what's a balance sheet, but make a list of their assets and their liabilities. Quite often, they'll forget to list this, and yet it's probably one of their 3 largest assets.
Absolutely. About a quarter of my clients don't list their retirement accounts until they're specifically reminded about it. And you're right, it's one of the top 2 or 3 assets that they have.
Right. Okay. Just to make this up to date a little bit, let's talk for a few minutes about some of the recent changes in the tax laws that are going to affect planning for retirement accounts. So I guess the first thing is this 3.8% tax on net investment income for high-income taxpayers. Maybe what do you think about that related to retirement accounts?
Well, the good news is that the distributions from a retirement account, you don't have to pay the 3.8% on.
Right.
The bad news is those distributions count towards how much income you have to determine whether you have to pay 3.8% on everything else.
Right.
So, it's not as good as it used to be, and the taxes for the health care law that we passed. But it's certainly something that factors into your planning as to when you take distributions or should you take a distribution if you have the option to do so.
Right. And even like what beneficiary that you may want to have for the account and so forth. We'll talk about that a little bit more later. How about the estate and gift tax exemption?
Well, Congress recently raised the estate tax exemption, so currently it's $5.25 million. It's highest it's ever been, and that number is actually indexed for inflation. So I would expect next year it's going to go up by, another $150,000.
So I've got actually the number. It's 5,340,000. The IRS has announced.
Okay.
So, but anyway, I mean it's almost another 100,000 has gone up.
Yeah. So, and the good news is inflation's low, so it's not going up
Yeah.
that much. But the bad news is, it's still not unlimited.
Yes.
Right. So some people are still going to have tax issues, but less people have estate tax issues than before. In the past, you had to pay estate tax on the gross value of that account, even though you had to pay income tax on the account when you took that out. That's probably less relevant for most people now, and they don't really have an estate tax issue. It's an income tax issue that they have to deal with in their
Right.
plan.
So it sort of shifted, the emphasis from the estate and gift area more over to the income tax area. What about this thing called portability? I know we can't get into it in any detail, but maybe again you could talk a little bit about the broad picture.
Well, portability just allows you to take unused estate tax exemption and leave it to your spouse, and then they get to add that to what their $5.25 million or $5.34 million that they're going to have next year. This is huge middle class tax saving, makes estate planning much easier for most people. When it comes to retirement accounts, then, if you name your spouse as the beneficiary, and they're a U.S. citizen spouse at least, right, they qualify for marital deduction, it helps your portability. It gives you flexibility for the future down the road, and that's really the advantage here.
Right. So no, but these are really the estate area particularly is a very significant development because in essence it knocks out all but maybe about 5%. I'm just throwing out a figure, but a very small percentage of U.S. households have more than $10 million.
Yeah, and I should say, even though this isn't a portability talk,
yeah.
If they did estate planning before 2000, and the reality is maybe even before today,
yeah,
they really should have their trust examined as to whether or not it fits for portability, because the old trusts are not income tax efficient anymore, and they really need to be redone.
Right. So, we want to encourage everybody to visit your lawyer, put it on. Maybe it's not going to happen in the next month or so, but put it on your New Year's resolutions for 2014 to get your estate plan at least reviewed and updated. All right. Now, there's one other item that sort of relates to this area that I'm just going to throw out. And again, this is one of the areas that we're getting ready to see age out, if you will, expire unless Congress does something. And that's the ability for somebody to make a gift of up to $100,000 to a charity when you're over age 70 and a half. And so this is something that you can do for 2013, but it has to be done by the end of the year. And by the time people see this, it may be after the year end, I'm not sure. But anyway, it's still, though, something to be aware of and to claim for your tax return. And keep an eye open for next year because Congress may well extend this.
Well, Congress has been extending it kind of off and on, and sometimes they extend it late, but they can call their IRA custodian and say, am I able to do this? And have that custodian make a direct withdrawal directly to that public charity. And that will, it just saves you from having your adjusted gross income, rise, which saves you all, the phase outs on deductions and so on.
Right. And the Medicare tax and what have you. So, net investment income tax. All right. So let's move on then into some of our other considerations for estate planning. So what are some considerations in choosing a beneficiary for a retirement account?
So strategically, there's a couple of rules, right, that make sense. The first one is charities before individuals. I mean, if you have any charitable intent at all, that you want to leave money when you die, your retirement plan accounts are the first place you want to take that money. And the reason is charities don't pay any income tax. Individuals do. So you get, the charity's going to get 100 cents on the dollar. Your kids may only get 60% of that amount, right? Now, secondly, obviously we look to leave money to spouses and stuff like that. But most of the time we're looking, if we're not leaving it to a spouse, we want to leave it to younger people rather than older people, all things being equal. And the reason is that when you leave money, for example, from an IRA to your children when you die, they have to start minimum distributions right away. We as participants are not required to do minimum distributions until we reach 70 and a half, right? But your kids will have to start minimum distributions right away. And so the older someone is, the less time they have to defer, the more they have to withdraw every year. So as a general rule, we look for younger rather than older beneficiaries. And then lastly, all things being equal, the lower income earning person is better than the higher income earning person. In other words, if you have one child who's a school teacher and another who's a cardiologist, the school teacher probably is in a lower income tax bracket, therefore they get a better benefit than someone who's in the maximum tax bracket, like the cardiologist probably is.
Right. And so this may have something to do with, again, what assets that you select. In other words, okay, I have my house and I have my retirement account. The house goes to the cardiologist and the retirement account goes to the school teacher. And those sort of fit that, because there's going to be a new basis for the house. It can be sold after death. It could be invested, what have you. The school teacher, again, can take an income stream and can probably use that income stream during their lifetime. So what does stretch out mean?
Well, stretch out is the term that we use to defer receiving all of the assets in that IRA all at once. So now, basically what it means is that if I die and I leave money to my 18-year-old daughter, she can stretch out over her life expectancy those minimum distributions. Of course, that's assuming that she doesn't want to take all the money out, or I haven't done something like put it in a trust to require her to only take minimum amounts out. But it gives her the ability to stretch out those payments for a long period of time, as opposed to, oh, I just received this IRA and I'm going to take it all at once.
Right. So particularly when you have younger beneficiaries, I think what it comes down to is these people need some education. That the temptation is, you see this bunch of money, if you will, to just take it right now. And the problem, of course, is that when you take it right now, it's taxable right now if it's a taxable account.
Well, not only is it taxable right now, but it also may be taxable at a much higher rate.
Yeah.
Because if you take it all out, you may put yourself into higher income tax brackets. If you spread it out even just over a couple of years, you could have saved yourself 5 or 10% in taxes.
Yes. And if you don't take it out, then that fund is still there that can be used to continue to earn additional income by being invested. And if it's, otherwise if it's just spent, it's gone. And so that's kind of a sad situation. And again, the temptation is there to go and just have a good time and, go to Vegas or whatever, but prudence doesn't dictate that strategy.
So there are methods that we can use, using trusts, for example, that you can require the beneficiary stretch out. In other words, that you're not going to allow them to withdraw all the funds at once, that they're going to have to take it over a period of time, whether that's over their entire lifetime or whether it's over at least a few years. We can put those structures in place, but you have to do that using a trust, not just naming a beneficiary, because if you name the beneficiary has control.
Okay, so maybe you can elaborate a little bit about this, because basically I think we're talking about conduit trusts, aren't we?
Exactly.
Yeah, so maybe you can explain a little bit about that.
So
idea.
a conduit trust basically is like a funnel, right? And when the IRA goes into the trust, right, the trust says whatever distributions come out of that IRA have to flow through to the beneficiary. So it's really about control. Who controls when distributions are made from the IRA? Does the beneficiary control, or does the trustee control? And when the trustee controls, they control based on the terms of the trust. So, for example, you can appoint someone to be the trustee who will then decide, I'm only distributing the minimum amount, or I'm going to distribute more. Whatever's distributed has to go to the beneficiary. It doesn't stay in the trust, but it's about who gets to decide when it comes out. Because beneficiaries, and studies show this routinely, beneficiaries who receive $500,000 or less tend to spend it all in 18 months. So having a trustee who is going to make sure that that gets spread out, or maybe saved for more retirement savings than the beneficiary who wants to go buy a flat screen TV or a new car, right? It may be the best way to go.
Okay. And this trust that we're talking about is not just like your typical estate planning trust. This is a separate trust that you're creating for this purpose.
It can be a separate trust, though we tend to put that language into our regular trusts.
So it can be sort of a separate trust created as a sub-trust or whatever.
Exactly. But you got to make sure that the attorney you're working with understands how to do this. You know, a lot of, even though these regulations came out in 2001, there are still a lot of attorneys who just are not up to date on how to create these types of trusts to make sure that you can take advantage of that stretch out.
Right. Okay. So what are the rules for required distributions that you have to plan for? I guess what I'm talking about is the required distributions for inherited accounts.
So when you inherit money, a non-spouse, when they inherit money, right, they have to make those minimum distributions. And the IRS has a table. They call it the single life table. And you look at the beneficiary's age, and it gives you a fraction. And you take out that fraction every year. And then, or in the first year. And then every year after that, you subtract one from your denominator. Right. So there's a larger percentage every year that goes out. And that becomes your minimum distribution. Now remember, minimum means minimum. That doesn't mean that's the only distribution or maximum, right? So the beneficiary, if they're in control, can always withdraw 100% or as much as they want. But they're required to at least take out that minimum amount.
Okay. What estate planning considerations apply for a retirement account that relates to a surviving spouse?
So surviving spouses have special rules, right? So, for example, if you pass away and you leave the property to your wife, right? She has the option of rolling that over, what's called a rollover, into her own account where she becomes the participant. And now she has the rules of not being able to withdraw funds without penalty until 59 and a half, and has to begin minimum distributions until she, when she reaches 70 and a half, right? A spouse can also just choose to take as a beneficiary and follow the general rules that all other beneficiaries have. Now, spouses are never required to make minimum distributions until the deceased spouse, the original participant, would have reached the age of 70 and a half. So they can always defer taking money at least until that person. So if your spouse is older than you are, right, they don't necessarily have to start minimum distributions at age 70 and a half. They can wait until you would have reached 70 and a half, and then they have to start their minimum distribution.
And that's sort of when it's their beneficiary account. In other words, they haven't rolled it to their own. Once they roll it to their own, it's theirs, and they're subject to their own.
Then they're subject to their own rules. And so, this is, we see financial planners sometimes make this mistake where, you call and say, my husband passed away, and they say, oh, we'll come in and do a rollover, for knee-jerk reaction.
Yeah.
But if you're 40 years old, right, and your husband just passed away, a rollover may be the last thing you want to do, because now you've locked the money up until you're 59 and a half, unless you have some, meet some other requirements. Whereas if you stay as a beneficiary, you can take the money out right away.
Okay, what about a Q-tip? Should you use a Q-tip qualified terminable interest property trust, should you be using something like that with a retirement account?
Well, maybe. So it depends on the situation. So if it's you and your wife and you have children in common, this is your first marriage, and stuff like that, most people probably aren't going to worry about that. Mm-hmm. If this is your second marriage and your spouse is not the mother of your children, for example, you may want to prevent them from being able to do a rollover and take all that money, because when they do a rollover, they also get to choose the beneficiaries, right? And so you may want to leave the property into a trust for the benefit of your spouse, so they can take the money for the rest of their life, for example, but whatever's left over comes back to your family and doesn't go to your spouse's family. So there are some benefits to that, but if you're using a trust, then you got to have that conduit trust language in there, or you're not going to be able to stretch out and you'll pay income tax, within 5 years.
Right. So I guess what I wanted to point out related to this is this isn't going to be just on the beneficiary form that you're going to get when you sign up for your IRA or whatever. This means that you really do need to be working with a lawyer and about who are the beneficiaries, and the lawyer needs to be talking to their clients about this.
No, absolutely. It is not uncommon for people to have multiple marriages, children from different marriages, and this is estate planning. It's not part of the traditional estate planning of the trust and the will. And when you go to the trust mill place that you see advertised in the paper for $500, $600, and they're not going to be giving you any advice regarding this. But these assets may be your biggest or your second biggest asset in your estate, and it is estate planning. And if you don't get this part right, you can lead to huge family fights.
Mm-hmm. Okay. Are there special considerations for a Roth account versus a taxable account?
So a Roth account basically is money that you've put in that you did not get an income tax deduction for. And so it grows, tax-free, and when you take money out, you don't pay any taxes. So there are some differences there. For example, when we talked about leave money to charity first, mm-hmm. that doesn't really apply to a Roth, right? That really applies to a more traditional IRA. But otherwise, the distribution rules when you die are the same. You still have the minimum distributions and stuff like that. Mm-hmm. The difference is the beneficiaries of the Roth don't pay any income tax when the money comes out. So stretching that out is an even bigger advantage than it is for the traditional IRAs, and much more important to kind of take advantage of that, because all that money in that Roth is tax-free when it's distributed. And
now again, we were talking about asset selection again, who you're going to be leaving what. The Roth account would be a really nice gift for that neurosurgeon as opposed to the school teacher. I mean, the school teacher would be glad to get it. Anybody would be. I'd love to have one myself, as an inheritance. But it's going to be your people in the high tax brackets that are going to get the most benefit from that type of an account.
Absolutely.
Yeah. So we just have a couple minutes left. Maybe you can just throw out one or two final ideas related to estate planning, related to these retirement accounts.
Well, I think that primarily most people don't pay much attention to them, as we talked about earlier. And it's important to work with an attorney, a CPA, to make sure that your beneficiary designations are up to date, that the right people are getting the money, and they're getting it in the right fashion. For example, if you have minor children, and you leave them and you die early, you're going to have a guardianship of the estate for that child to be able to hold that IRA for them until they turn 18 and then they take over. Not only is that expensive, but it may be very damaging to your child. And you really should have that IRA going into a trust where someone else is making those decisions, at least until the child develops a little more maturity. They still get the minimum distributions, and those pass through to the child, but you don't have to, incur all the legal expenses that you would otherwise. If you work for, one of the high-tech companies in this valley, for example, or just any large company, your 401k is generally governed by a law called ERISA. And that automatically names your current spouse as the beneficiary of your plan, whether you've done a beneficiary designation or not. And in fact, the only way to change away from that is to have your spouse sign something. A prenuptial agreement does not work for that. You have to do this after you're married. And so people who don't do that find that their second marriage, all of a sudden they're getting the bulk, all that 401k, and that wasn't what their intent was at all. And it may be in complete violation to what they thought they had in their prenuptial agreement and other estate planning documents. So it's very important to make sure you get professional advice on what's the best thing to do and protect your family in this area.
I'm thinking that you may even need to, well, one, when you're talking about things like you were just talking about, each of the spouses probably needs to have their own attorney because there's potential conflicts of interest. And also, though, you may even want to get a family law attorney involved in addition to an estate planning attorney. What do you think about that?
Well, in some circumstances, you're going to have to do that. Of course, the fastest way to spend money is get attorneys talking to one another.
Right.
So it really depends on the situation and whether husband and wife are able to kind of make some agreements together or whether they're going to really have a conflict. Most people can work with one attorney, I think, but not everyone can. And it really depends on, when they come into that office, what they've already decided beforehand and how they're handling, things in the future. But, oftentimes both husband and wife are working and they have their own assets in those retirement accounts.
Okay. Folks, we're all out of time, so I hope we've given you a lot to think about. We'll see you next time on Financial Insider Weekly.